Hey everyone, welcome back to Corporate Decoder, the place where we slice open financial documents to find the juicy bits. Now get ready because today we are diving into the USVC Venture Capital Access Funds filing. And let me tell you, it's a story about venture capital access and a whole lot of risk. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. It's also worth checking out our Discord community, linked in the description below, where we dive deeper into these topics. So what is this fund all about? Basically, it is a way for everyday investors to get a piece of the venture capital pie. Think of it as a fund that invests in other funds that then invest in private growth companies, many of which are tech-focused. Sounds exciting, right? Well, the initial price per S-Hair, they are looking at $20, and the maximum offering. They are aiming for up to $1 billion. That is a hefty sum. But before we get too starry-eyed about unicorn investments, let's talk about the cost because that is where things get really interesting. This table shows total annual expenses, and what we see here is pretty telling. The total annual expenses are currently pegged at a hefty 3.61%. Now, usually that number gets whittled down by fee reductions and expense reimbursements. But here, and this is crucial, the net annual expenses remain a solid 3.61%. That means for every $1,000 you invest, a significant chunk is going towards keeping this fund running before you even see a penny of return. And it gets even more interesting when you look at how they make money getting you in the door. This filing clearly states the maximum sales load imposed on purchases is 3.0%. That means right off the top that 3% of your investment could be going towards sales commissions, not towards actual investments. While they mention waivers are possible, they are assuming the maximum is charged here, so that 3% is a real upfront cost you should expect. Now for some good news though, there is not much of it here. The Fund S Board of Trustees has determined to waive the fund. S repurchase fee. This is a fee you would normally pay if you wanted to sell your shares back to the fund within a year. So they are waiving that 2.00% fee. This waiver is indefinite. But as they explicitly state, this waiver may be terminated by the Fund S Board of Trustees at any time. So while it is a relief now, it's something to keep an eye on. Now let's shift gears a bit and talk about where they intend to put all this money. The fund's investment objective is long-term capital appreciation. They are aiming for growth. They plan to invest in venture capital funds and private growth companies, especially those in the technology sector. We are talking about information technology, artificial intelligence, life sciences, and so on. They even mentioned that these investments may partially hold digital assets and cryptocurrencies, so they are casting a wide net in the hot sectors. However, and this is a big however, they are not planning to directly invest in digital assets or cryptocurrencies. They will invest through other funds, which means they will bear those funds' fees and expenses indirectly. And for how long will they hold on to these investments? The fund will generally hold portfolio investments until a liquidity event or dissolution event occurs. This means they plan to invest and hold for the long haul. If you are looking for a quick turnaround, this is probably not the investment for you. They are essentially banking on these private companies eventually going public or being acquired. This brings us to one of the biggest warnings in this entire document. The filing is very clear about the illiquidity of fund shares. There is no active market for these shares. You cannot just sell them on a stock exchange. Your only option for getting your money out is through a quarterly repurchase program offered at the sole discretion of the board. This means even though they aim to offer some liquidity, it is very limited and not guaranteed. They are telling you directly here you should consider the fund's shares to be illiquid. This is a critical point if you need access to your money in the short to medium term. And when they talk about risks, they really mean risks. This section is a significant red flag. It plainly states our investments in portfolio investments may be extremely risky, and we could lose all or part of our investments. They highlight that the companies they invest in may have limited financial resources, no operating history, and be vulnerable to competitors and market downturns. This is the nature of venture capital investing, but it underscores that this is not for the faint of heart. The potential for complete loss is very real. They also dedicate significant space to the risks associated with the information technology sector. Remember, they are concentrating at least 25% of their assets here. This sector is known for volatility, rapid changes, and product obsolescence. So if the tech market takes a hit, the fund will likely take a hit too. This concentration amplifies the risks they are taking. Now let's look at who is running the show. The filing is quite upfront about the lack of operating history for the fund itself. It also points out that the investment advisor Strawberry Tree Management Company LLC has no previous experience managing a closed-end registered investment company. This is a really important detail. They are essentially a new player managing a new fund. They also mention they are initially reliant on a few key individuals for implementing their investment program. The departure of these individuals could significantly impact the fund's performance. They intend to hire more people, but right now the team is lean and new to this specific type of registered fund management. Let's circle back to the fees because this is always a major part of any financial filing. The advisory fee, the fee paid to the investment advisor, is 1.00%. This fee accrues daily on the average daily calculated net asset value of the fund. So even if the fund loses money, they will still be paying that 1% fee based on the remaining net asset value. This means the manager gets paid regardless of performance. That is a common feature in asset management, but it is something investors should always be aware of. On the tax front, the fund intends to elect to be treated as a regulated investment company, or RIC. This is a common structure for investment funds that allows them to avoid paying corporate income taxes if they distribute at least 90% of their earnings to shareholders. Essentially, it helps prevent double taxation. However, they mention that meeting the requirements for RIC status can be complex, especially when investing in private funds, which may not provide timely or complete information about their holdings. This lack of transparency could jeopardize their RIC status, leading to corporate-level taxes, which would eat into returns. Looking at the financial statements, which are as of July 2025, we see a picture of a fund in its very early stages. Total assets are listed at $20955. Liabilities are $10955, and that leaves net assets at a modest $100,000. This means that right now the fund is not fully operational, and its assets are primarily seed funding and deferred offering costs. This is typical for a fund just getting off the ground, but it highlights that the $1 billion offering is the real goal, and the future of this fund depends heavily on achieving that. And speaking of costs, the organizational costs are listed at $100,000. These are the costs associated with setting up the fund, its legal structure, and initial services. The good news is that these organizational costs are being reimbursed by the advisor. However, they also mention that this reimbursement is only required if and to the extent that the fund's net assets exceed $20 million. So if the fund doesn't grow sufficiently, early investors could end up bearing a larger portion of these startup expenses. To try and mitigate some of these costs, the investment advisor has entered into a written expense limitation agreement. This agreement caps total expenses, excluding certain items like management fees and acquired fund fees, to 1.00% of the average net asset value for 1 year. This is a positive step to control costs in the short term, but it is only for a limited time and continuance requires approvals. Also, they note the investment advisor may recoup fees previously reduced or expenses reimbursed. So while there are limitations, there are also mechanisms for the advisor to recover costs, which could impact future expenses. Now, this is a rather unusual clause. It mentions that the fund may repurchase shares held by a shareholder if their ownership could cause the fund to violate laws or regulations or be harmful or injurious to the business or reputation of the fund or its affiliates. This gives the fund a lot of power to potentially force out shareholders for reasons that could be quite broad. It is a strong safeguard for the fund, but it is something to be aware of as a potential investor. So what is the verdict on the USVC Venture Capital Access Fund? On one hand, it offers a unique opportunity to access a portfolio of venture capital investments in high-growth tech companies and potentially digital assets for investors who might otherwise not have that access. The fund is structured to invest in other funds, which gives some level of diversification within the venture capital space. However, the risks are substantial and clearly laid out. The fund has no operating history and is managed by a new advisor with no prior experience running a registered investment company. The investments themselves are inherently risky and highly illiquid. You are tying your money up potentially for a long time with no guarantee of return. The fees are also a significant factor to consider, particularly the upfront sales load and the ongoing management fees, which are paid regardless of performance. The lack of liquidity in both the fund shares and its underlying investments is a major concern. As for strategic direction, it appears to be focused on the right high-growth sectors, but its execution and management team are new to this regulatory environment. The concentration in technology also adds another layer of risk. In conclusion, this fund presents a high-risk, high-reward scenario. It is tailored for sophisticated investors with a very long time horizon, a high tolerance for risk, and a clear understanding of the illiquidity involved. For the average investor looking for steady returns and easy access to their capital, this is likely not the best fit. It is essential investors do their own thorough research and consult with financial advisors before considering an investment. Alright, that is our breakdown of the USVC Venture Capital Access Fund filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.